Joining us now to make the case is Jerry Castellini. He is president and CIO of CastleArk Management. Jerry, have you been tempted yourself by some of these, treasurydirect.gov and all the rest of it?
I mean, why not? For the part of a portfolio that needs consistent returns and doesn't have risk, you bet. I mean, it's a gift. But let's not forget about the gift you have in stocks right now at the same time, and all the negatives that I think by this point there's not going to be any real surprise that we're in a tough economic environment and one that will probably find its way out at some point.
Right. So you are supposed to be here to make the case for people to stay in the market. Why should they, Jerry? Why shouldn't they just go, you know what? This is so uncertain. I will take the certainty of that, 5% or what have you. Granted, depending on the time frame, they may have to figure out how to reinvest that in 6 months' time.
Yeah. 3 points. First point is we're overly obsessed with the Federal Reserve and all the things they've done and they tell people about and we analyze. The reality is Fed's done their job. Long-term inflation is expected somewhere in the twos. That's their target. We're there. We're worried about where short-term stuff is, and they're telling us they're going to stay hawkish, and that's great. They've taken all the excess out of the system. Close to 100% of all economists and 70% of all CEOs expect a recession. There's no surprise here if one comes. So if there's no surprise, then all of investors in equities have to be looking at stocks where a recession has been dialed in. And I guess my point is, why would you have further downside risk when everyone's already expecting the worst? And think of the other side. At some point,
I want to come back, Jerry, if I might, to something you just said. Forgive me for interrupting. I think I heard you say that the Fed wants inflation in the twos, and I think I heard you say we're there.
We're there on the 5-year.
On the what?
On the 5-year inflation, the 3s to 5-year inflation adjusted tips.
But we're not there yet. But we're not there now. I mean, we're not there today, and that's why the Fed is going to continue to raise interest rates. I mean, I don't know how you can possibly say that we're there. I mean, the market, the 3 to 5 year market, may be betting that we're going to get there, but we're not close yet, and that's why Powell sounds so concerned about a hot economy.
So that's the point, though. That economy, that expectation for a slowdown, has been discounted in stocks. It's been discounted in the forward 10-year return, and it's been discounted in the far-out bond market. You can argue that there's more to come in terms of pain, but when you break the economy apart, you don't have the classic. So if you go look at consumer balance sheets, you look at corporate balance sheets, you look at the labor markets, all of the things that have historically caused really bad recessions aren't present today, or nearly all of them. And meanwhile, all you have is the Fed with a big stick trying to swing at something. My point is they're going to need to unemploy about 1.5 million people to reach these kind of goals of higher unemployment and looser labor markets. And they're not going to need to. We're already at the point now where all these indicators have given you enough room as an investor to say, maybe there's more upside than downside risk here.
You're sounding like Elizabeth Warren, Jerry.
Nah, I don't think she's an expert in upside downside risk, but I could be wrong. The point is, if you abandon stocks just because you can get 5% T-bill yields, you're asking yourself to act as though you can see beyond something that none of us can see. But if you look at MasterCard or Las Vegas Sands or Exxon or these big companies that are doing just fine, whose earnings estimates have already been adjusted lower, why wouldn't you take the chance today that that's actually going to be a conservative outlook a year from now? And that's the job of an investor, right? Our job isn't to sit here and angst over what the Fed's doing in March of 2023, but we have to look forward at what's going to be the economic environment in 2024.
If we go to new highs this year, so some have said, Jerry, to me, that they think the market can make a run to new highs this year before we reverse lower. I mean, is that a situation where you ever at some point say to clients, okay, this rebound has come too far, we're moving to the sidelines?
I mean, where is it going to come from? I'll use the example in January. The rally came from a lot of the bounce moves in some of the high tech names. I would say those will expire, and they already have. But if you ask me the places, and think about this, the S&P 500 is trading at 14.8 times every name except the top biggest, the FANG stocks. That's a very attractive, target-rich environment for investing in stocks, even if you have to pay 5% interest rates. Historically, we've been able to value stocks at 20 times with 5% interest rates, and now we get them at 15. And that gives you a broad universe of names to buy without worrying about what some business with no earnings is going to do.
MasterCard, ExxonMobil, Las Vegas Sands, he's taking them to the bank. Jerry, thanks for your time today. We appreciate it.